Look at any trading floor, and you'll see a frantic blur of glowing monitors, ringing phones, and yelling brokers. It is an environment engineered to make you feel like every second matters, and that standing still means you're falling behind. This creates a dangerous illusion for everyday investors. We start to believe that actively making moves, buying, selling, and reacting to the hourly news cycle is the only way to make forward progress in wealth building. But when you examine the highest levels of institutional finance, the environment changes completely. The absolute masters of capital spend almost no energy chasing daily gains. Instead, they obsess over a single, deeply unglamorous goal: avoiding catastrophic loss. True financial power does not come from hyperactive market participation. It comes from the calculated discipline of extreme calm. No one embodies this calm better than Warren Buffett. He is the ultimate architect of this institutional patience. He operates his entire empire on two foundational rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. We tend to treat that quote like a catchy motivational slogan, but it is actually a rigid, unforgiving mathematical law of survival that dictates whether a portfolio lives or dies. To understand why capital preservation must be your absolute priority, you have to look at the math of market drawdowns, specifically a concept called asymmetrical friction. Human brains naturally assume that recovery is linear. If your portfolio drops by 10%, it feels intuitive that you only need a 10% gain to fix it and get back to where you started. This chart shows why that assumption is flawed. Your available capital shrinks after the initial drop, so getting back to your baseline requires an 11% return, and this scales aggressively. If a bad trade cuts your capital in half, a 50% loss, you now have a massive 100% gap to close just to break even. This asymmetry destroys the long-term compounding power of your money. Instead of letting your capital grow year over year, you end up spending years of time and effort merely trying to crawl out of a hole. Time becomes your enemy. Because every single dollar lost is exponentially harder to replace, eliminating downside risk becomes the only mathematical way to win. Elite investors know they cannot afford to trigger this math, so they mathematically eliminate the risk before a trade is even made. They do this by operating within a strict systemic framework known as the circle of competence. Looking at this diagram, you see a clear boundary line isolating a specific sector from a chaotic math of noise. That circle represents what an investor deeply understands. It takes extreme discipline to maintain that perimeter, requiring you to explicitly reject highly lucrative, trending opportunities simply because they fall outside your intellectual boundary. This cuts against the typical retail habit, where the fear of missing out drives everyday traders to gamble on misunderstood trends. True risk management is the absolute refusal to play a game where you do not hold a distinct, proven edge. Once that boundary is drawn, it strictly dictates the physical execution of capital. Often, the resulting action looks like absolutely nothing, but sitting on cash is not passive hesitation. It is a highly active, aggressively defensive posture. This is the fat pitch strategy. It is the deliberate act of hoarding capital, locking it safely away until a mathematically perfect, virtually risk-free setup appears strictly inside your circle. When that rare, perfect alignment finally reveals itself, the capital is not trickled out. It is deployed with overwhelming, disproportionate force. Extreme patience is the ultimate mechanism to starve the brutal math of loss. The amateur trades daily, taking constant risks that trigger the punishing math of loss. The disciplined master trades rarely, deploying capital only when the downside is heavily protected. This reveals the ultimate paradox of Buffett's rule. By obsessing completely over preventing the loss of money, massive wealth generation happens automatically as a mathematical byproduct. Adopt this institutional mindset. Keep building your knowledge, keep protecting your downside, and prepare your capital for the next wave. Wealth isn't built by how much you make in a single afternoon. It's built by how well you refuse to lose it over a lifetime.